moment to thank Shashank Dogra for agreeing to my request of coming to tell about his journey and, of course, the strategies which we'll be discussing down the line. And those who are not familiar with Shashank, so he's a flexible investor, which we call, and he's a strong proponent of using multiple strategies to our advantage. And we'll be discussing how retail can benefit from because the initial capital is comparatively low for the retail investor. So how that can be used to our advantage and how we can grow our portfolio 100 times. So welcome, Shashank.
Thank you so much, Prince, for the very kind introduction, and thanks for having me. It'll be a pleasure. And you're doing a wonderful work, man,
Uh,
for all the people you're inviting, and very insightful.
Right, right. And the credit for today's session goes to Ameya who made it
Yes.
happen. And without wasting any time, Shashank, what's your starting point? What is your scanning strategies and how you go about it?
Sure. I mean, just to give you quick introduction. I mean, I came into the markets in 2018. So yeah, and from since then, got like at that time got introduced to value investing, and I started with that, and slowly picked up on the technical investing and technical analysis and momentum investing. So gradually, then at this stage, I've developed some my personal way of investing, which is like I would call flexible investing, which is basically taking the best from every strategy. So yeah, so how do I? That's a good question. So how do I scan stocks? So a very honest confession. I mean, I do not personally, consider myself a champion of value investing, techno fund, or momentum. So what I do is basically I study these individual strategies, in like generally. Then I come to an inflection point where all these three merge together. So that's how I do it. Now, for a retail investor with a limited capital, this can be a bit tricky because to be an expert in either value, techno fund or momentum, there needs to be a lot of efforts that you need to put in to understand pattern recognition of each style, and that's it's like quite time consuming. So what I do is I blend all these three together. I follow some advisors. I take help, and yeah, and that's how I do it. So this is what I call you know in the Hindu mythology, in Rig Veda, there is a word called Triveni Sangam. So Triveni Sangam is basically where the Ganga, Yamuna, and Saraswati, these three rivers meet together, and it's considered to be a holy spot. So same goes for investing for me. So wherever value, techno funda, and momentum merge together and give me and throws stocks that are uh, common to the strategy, yeah, so I pick stocks over there. And see, one thing I want to emphasize for a retail investor is that you don't have to be an expert in any of these strategies in order to make money. That's what I've observed. So you have the biggest advantage of small capital. So use that to your advantage rather than a specific strategy. You need to like you need to run your portfolio like a company, like a business. So you have to hire, let's say, a people from operations, people from sales, or people from manufacturing, and like that. So I consider these investing styles as hiring people who are experts in their own fields. Then whatever, let's say, input they give me, I take a decision on this to run my business. So yeah, that's how I look at it.
Right, great. So, Shashank, I mean, you talked about you started with value investing. So, how it had evolved over a period of time, and like how it strike you that you have to club these strategies to your advantage.
Yeah, so yeah, it's a very good question again. So see, what I've observed is that there is a if you analyze the wealth creation as a journey, right? You have a you have in an investment process there is a value chain. So value chain is on the top there is a promoter, and on the second shelf, the second rank, there would be institutional investors, or you can say the HNIs, And on the third part, you have the retail investors. So we basically come as a retail investor at the third bracket. So at each stage, you have an advantage. So value investing to me personally, I've seen it from very closely, is the best strategy for a person with high capital base. High capital base because you see, even if you're not patient with your capital will make you patient because you can't move big money to take advantages of arbitrage or anything, right? So that strategy, I'm not saying value investing is bad at all. Huh? If you are a retail investor and you can follow value investing, the best for you, right? For me as a retail investor with a smaller capital base, I find it more beneficial to change my strategy as per the convenience to make and generate the alpha that is needed. So this was one of the reasons why what this is one of the reasons why it intrigued me to study techno funda and momentum, because these two strategies, if you see, they are benefiting from the price action that is happening, which is the human sentiment, right? So basically, in the longer term, you you earn money if you can benefit from the human sentiment and from the actual earnings of the company. If you see, if your horizon is super long term, right, you will earn in two ways. One is by PE multiple getting re-rated, and second is by earnings, right? And in between, there is a stage where you actually can earn from the human sentiment also, which is called, like in momentum there is FOMO, right? Fear of missing out. That's why momentum stocks keep working. So in order to blend my returns, so I this is was the reason I blended techno fund and momentum. And I'm telling you one thing, I follow value investing also, but it's just that, and I read about it also, and I know that beyond a particular capital base, none of the techno fund or momentum would work. Only value investing would work. See, understand one thing, and observe this. When you look at stock, when you look at prices, and when you look at charts, someone is making a chart, right? And that person who is making a chart, who is making that candle, is not following charts. So these are the value investing guys with a lot of capital. So that is where value investing has its the most critical edge, according to me.
Right, Shashank. So basically, how we can, zero in on an idea basically where we can see that all the three things are working in sync, so that we can accordingly allocate. And what's your allocation strategy from, say, if we ask about from retail's point of view, what should be an ideal allocation strategy?
Sure. Okay. So firstly, I mean, see, the way I zero down on stocks is like, reading helps a lot. So you need to be a voracious reader. You need to see how the trends function in generally. And I'm a very strong proponent of reading books on, different investors. Not particularly different, like a specific style of investing, but different investors practically, be it fixed income traders, be it macro traders, be it any kind of a trader that you can get your hands on, or an investor. Read about what they have done. So this would help you connect dots, number one. Second thing is that you need to have a basic hang off each strategy, what value does, what technofunda does, and what momentum does. So when you understand the pros and cons of each strategy, then you blend together. Like for example, it's better to give an example and tell you. So for example, I recently took a very big position in a cement stock, right? So how did I zero it down? So first thing I zeroed down was that in around August, I think July August, there was an interview came from a very famous value investing champion, that I mean, we like cement as a sector, right? So at that time, what I said was, okay, that was this person from the value camp has a reputation in there. Okay, let's study cement. So zero it down on a cement company. That okay, this particular thing looks good, and then that same company started making noise on the technical side. that there is something technical activity happening in the same company. Now, looking at the fundamentals and everything, then after that, there was a momentum also that came in of that particular stock. That momentum investing is also like, in that scanner also again it came up. So that was a time I've had enough conviction and had studied, of course, this company, and had an idea what these guys are doing. So then I allocated a really big percentage to my portfolio. When I say big, I even, like, I mean, I'm the kind of investor I am. I even go beyond 50%. So that's how I allocated. Let me just give you a little brief on how I think about allocation, and what this whole thing of 100x and everything. So see, in allocation, I'm very aggressive as an investor. So in order for you, let me give you some data points. In order for you to make 100x on a portfolio level, right? So what you have to do is, mathematically, I just tweeted this recently, just few minutes, I think, half an hour back, that for you to make 100x out of a portfolio, you just need 50 trades, or 50, let's say, decisions that you have to make, and you just need to look at a 9.65% average gain per trade. That's it. So you are basically capping the greed of a multi-bagger. Generally, what we do is that we have a perception that, oh, when I buy a stock, that the stock should go at least 10 times, 20 times, 30 times, 50 times, 100 times, right? So that's fine. That's perfectly fine. But this strategy and this part of thinking that the stock should go this much high is ideally suited for a person who is sitting with a huge capital, because he is the one who cannot actually afford this strategy of 9.65, or 12%, inclusive of taxes and cost, to execute the strategy. Because why? Because if someone, let's say, is having 100 crores, or let's say, there's 1,000 crores of capital in one stock, let's say, for example, fictitious, how can he enter and exit for a 12% gain? He would move the price by 12%. But you, as a retail investor, you have this advantage that you can do that. So I use that part, uh, you know as an allocation strategy. So for me personally, I never have more than 5 stocks. I mean, I've done with 10, I've done with 15, I've done with 20 at time, at one point of time. But I figured out one thing. I mean, this personally is not working for me. I'm not that type of investor. I would rather look at smaller number of stocks and allocate very high percentages to stocks that are meeting my criteria of value, technofunda, and momentum altogether. And once I get this thing of value and all these strategies together, then I do it through risk management. So I mean, there have been stages I was just holding one stock in my portfolio, and I was very clear on my risk management thing. And I'm, let's say, if it is not working, I'm ruthless in coming out also. So I think I just wanted to mention this as a caveat. Though there is there's a, like, a benefit of this strategy, and there is a drawback also. So you need to be a ruthless risk manager. So for me, allocation, like, not more than 5 stocks, and yeah, 9.65 is my thing, and 12% is what I look for. But anything that above that, I keep trailing ruthlessly. And see, if I'm looking for, let's say, only 50 trades for to make 100x, so what exactly am I doing? I can make these 50 trades from a single stock also. It doesn't bothers me. So when you have taken out the greed of a multi-bagger from your, from your wish, like, from your, like, decision making, you look at every stock very, very objectively. You basically say that I am at X place, I need to go to Y place. X place is, let's say 1 lakh, and you want to go to 1 crore. As a retail investor, I'm just interested in the journey, and anyone who takes me there, I'll come along with them. That's it. So even if one person can take me there by entering and exiting 50 times, I'll do that, because at the end of the day, the capital would remain the same. I would get my 100x. Now, if you think of replicating this strategy for an institutional investor, or when you go grow beyond a particular size, I don't think so it is advisable, because you won't be able to come out with these kind of numbers. So just to give you a few numbers I worked on, for 100x, you need 9.65% or 12% per trade, repeated 50 times. You want to grow your portfolio 50 times, it is 8.14, repeated 50 times, and inclusive of taxes and costs would be 10% per trade. And for 20x, it's 8%, and 10x is 6%. So when you start thinking, so the point I want to make, and I want to tell retail investors, is that think on a portfolio terms. That is what is going to make a change. So you having a 50 bagger at 5% allocation won't like change your address, won't do much to it. It might give you a little bit of a fame, but it won't move much for you. So you as a retail investor have a biggest edge in allocating capital, which institutions don't have. Use that to your advantage. Don't be greedy that, oh, I want to invest all my capital and I want to wait it for it to become a 100 bagger. No, no one knows if it would become a 100 bagger. An average duration for a 100 bagger is at least a decade, or let's say 7 8 years, right? But if you take the benefit of price action and all that, you can actually compound capital very fast. And I'm not saying this just by just because it's mathematically compatible. Just look at the recent, just read Jack Schwager books. The recent one he said, and I tweeted also, there is a yellow text. People have made like 330% return for 27 years, 330% compounded. Can you imagine? Can this happen? Can this ever happen to an institutional investor? No. Why? Because their capital base is huge. But can it happen to a retail investor? Yes, because the capital base is small. What does it need? So what is basically needed from you? Two things. One, you need to remove the greed of a huge multi-bagger from one single position. If it happens, it happens. Okay, don't deny it. But if it doesn't happen, don't be sad about it. There are multiple ways to skin the cat. So the second thing that for this strategy one needs to be very very careful of is drawdowns. Drawdowns can happen, and you have to be very very disciplined in cutting your losses. So my personal strategy is 8%. I don't go below 8%. So some would say that, okay, if 8% is your thing, let's say if a stock goes 15% and it jumps back and it starts moving up in the other direction, I said no problem. I'll rebuy that stock. I'll be very happy if the stock proves me wrong. Why do I get happy? Because I want to get to my destination, boss. I don't want to waste my time on the anchor bias. Let's say if you buy a stock at 100, okay? Now it goes down to, let's say, 92, which is my 8% threshold. I'll go out. No problem. Now let's see what happens. The stock goes to 85, right? वहां से 85 जा करके, and then it turns back. Then at first it crosses 92, then it crosses 100, and then I'm just keep watching. Oh, miss हो गया. No, why? क्यों miss हो गया? Why? It's a psychological barrier. Miss हो गया. Why don't you re-enter the stock again? My personal strategy is I will not enter at 92. I will not enter at 100. I want the stock to prove me really wrong. So I will enter again at 107 or 6 or something. 7% I give a leeway. That reprove me really wrong, then I'll give you again my capital. No problem. I'll accept my mistake. See the psychology behind not rebuying the stocks that you once had and now became a multi-bagger is this. You take a decision at 100, market proves you wrong. The stock goes to 92, right? You said, okay, I made a mistake, you come out. Okay? Now market again proves you wrong by touching 85 and moving up. जो हिंदी में कहते हैं, जब दो बारी गाल पर थप्पड़ खा लिया ना, तो फिर बच्चा रो पड़ता है. Okay, so in this particular case, you don't have to cry. You have to get back. That if you are worthy, I'm going to get in. So that's how I basically allocate.
So perhaps like when we try to club these strategies, there has to be some patterns which can be used to our advantage. So any pointers on that you want to discuss?
See patterns. देखो wealth creation कैसे होती है? Wealth creation happens only in one way. When your PE re-rates and your earnings comes. So these are the two guru mantra basically of a stock to make the the trajectory of the movement sustainable. Because beyond that, I don't think so. Price unless it is a pump or dump, it won't move. So these two things have to be the part of it. So this is you can say my foundation, multiple re-rating and earnings. So yeah, so this is one, and the second thing is the price action. If the price action is coming up very nicely, I don't care what, whichever sector you are in, आप मतलब उसी भी sector में हो कुछ भी हो, I'm going to manage my risk and I'm going to jump in. I personally, since I said it to myself that I'm not a subject matter expert of a particular area, be it manufacturing, be it IT, be it pharma, or be it anything. If I'm not, then I'm fine, no problem, no harm. I have two things that I can manage very well. One is my allocation, and one is my risk. And these two are part of same strategy. They don't come if or. If I'm running, let's say, at times one or two, three stock portfolio, then I'm ruthless with risk. So that's how I do it. So fundamentals are main, price action is the other. So I blend these two basically. So the indicators are, as I told you, earnings have to be there. If the stock is moving, earnings are not coming or something like that, I'm not interested. Not that much. So cement sector, for example, I took the recent trade. The idea was same. Value club, value club says, oh, oh, can you hear me? Yeah, Prince, can you hear me?